market prices. One of the things that's really affecting us right now, this is, if we look at it last year from last week, really where these drought conditions were occurring, that last year those limited our herd expansion. There in parts of Texas and a lot in Louisiana, and then in California as well. Well, California's still in that drought. We fast forward 1 year, and then here in the southeast, there in North Georgia and Alabama, I've actually talked with about 5 producers that have liquidated a fourth to half of their herds. So all of that expansion that we saw in Georgia and Alabama, I think we're going to go back the other way in terms of cattle inventory numbers in this northeast Georgia and Alabama place right there. They've been feeding hay since July. So they've been this dark red for the past 3 months, and there's no hope in terms of winter forages there for them. So they're going to be feeding hay till about April is what their plan is. And
Still not working.
Stand on
Some
the
of them
other side.
reducing their herds because of that?
yeah, we've seen, I've talked to at least 5 guys in that North Georgia, Alabama range that they've culled a fourth to half of their herd.
Yeah.
Oh. You got 2 clickers up here.
Go ahead, James.
I swear, that was the one that got handed to me. So yeah, in that region right there, really experiencing some drought. And then the outlook at the same time for rainfall in this southeast corridor, you know, it's looking like we're going to have drier than normal conditions until next July. And then on the flip side of the drier than normal, at the same time you typically see warmer than normal. So in terms of the drought monitor there, we're in bad shape heading into the fall months if in terms of producing some more forage to extend that grazing season. We're looking at some tough times here for the next 6 months through June 2017 there. So then get into cattle prices. Obviously over the last 18 months, starting in that July 2015, we really started that downward spiral in terms of these feeder calf prices. These are U.S. average. Obviously, we don't have the market report system here in Alabama that does record them for us for the state of Florida. These are going to be our U.S. average prices for 550-pound feeder steers, and currently we're at $124 a hundredweight. I just watched some feeder steers sell about a week and a half ago, and they were in the 95 cent to $1.05 range here in South Florida. And so what we're seeing right now is we're seeing the beginnings of that meat production that's occurring from the heifers that we kept back over the last 2 years. So we're just now starting to see that increase in terms of beef production from the herd expansion that we've been moving through for the last 2 years. And then just on a U.S. average basis, we're now below $700 a calf for these 550 weight steers. So as we move forward here, hopefully we can get a seasonal spike these last 2 months of the year going into 2017. Specifically, I just wanted to show a couple more on these prices. Was that you know, where we are here in October 2016, coming from that high that occurred back in December 2014, we've lost 56.8%, and it's the largest decline in any 2.5 year period that we've ever seen going back to the early 1900s. So we've entered into this downward spiral in terms of these feeder calf prices, and now we've got increased beef production. So anytime we increase the supply of something without adequate increases in demand, and demand's going to be lacking for the next 2 years as we've got these global uncertainties. So we're gonna continue to move back on price, not at the same rate that we have over the past year and a half, but we're still going to see some weakness in terms of prices. But this chart just shows us on the dollars per hundredweight that we've lost all those gains that occurred over the last 6.5 years here. We're now trading at $124 a hundredweight. That's the same price that we were receiving in November and April of 2010. So basically, we've got a lower level of inventory than we did in 2010, but the same market prices. And that's because of the demand for our product is faltered over the last 2-year period here. And then just again on dollars per head, you can see the same trend, but we're trading under $700 a head on the U.S. average. We're $75 back of this U.S. average here in the state of Florida. So we're definitely hurting here on the market prices, and in the short run, I don't see much relief for us there on the coals. Watch some coal cows sell in that 45 to 55 cent range over the last month and a half here. So as we move forward, there's seasonal strength in the coal animals. So we do have that one thing going for us in the 3 to 4 month range. Again, and this is it set us up for this herd expansion to take place, to really start getting that beef production moving through our system as we've had this downward spiral in terms of these calf prices. So I want to make sure we understand that the herd expansion that has occurred so far hasn't contributed to the decline in calf prices. So all the retention in terms of these heifers, it's only held back beef production. And those heifers that we've been saving in 2014, 2015, only until the last month and a half, September, October, has that beef entered into our marketplace. That those heifers, they've had their calves, those calves have made it through the feedlot, and they're just now beginning to be slaughtered. So that's why we have this increased beef production occurring now, and it's going to occur over the next two and a half years here. So as you can see, the blue line is going to be our 2016 steer slaughter numbers, and the dotted blue line is going to be the 2015 numbers. You see the increase from over the last year in terms of our steer slaughter numbers, and then compared to the 5-year average, we're right there on the 5-year average on steers. So the only thing that's really changed over the last 5 years are these heifer numbers that we're about to look at. And that's where we see this large reduction in terms of these heifer numbers. We see that over the first half of 2016, the same strength in terms of holding back these heifers that we saw in the United States. So over the first half of 2016, we were still retaining a large amount of heifers. They're in the 6 to 8% of the first half of 2016. So that it shows us that they're, for the first half of 2016, producers in their mind, they were still really going to increase the size of their herd. Now, most of this expansion, we only increased in the state of Florida by 9,000 beef cows here over the last year. So most of this expansion is occurring in the Midwest, and we expect to see the same trend here this year. The good news is, they got the signal from the low cattle prices that we're starting to reach a critical point there, and they're moving those heifers back into the slaughter mix there in 2016. Beef cow slaughter is the other side that we really have to focus on beef production, and that is it's above year-ago levels for the most part of the year, but they're not slaughtering at the rate that we expected them to. This is actually in 1,000 head, so you would expect us not to be at where we were from 2010 to 2014 with a smaller cow size that we have now because of the liquidation that occurred. But we still would have wanted a little tighter trend there between 2016 and 2010 to 2014. We talk about one of the reasons for the decline in prices is one way they were increasing beef production over the last year and a half is with these larger slaughter weights. And you can see the trend, it stayed pretty true here to 2015, so they haven't varied there much in terms of these steer slaughter weights. We're still dressing these animals out over 900 pounds for the steers. And we expect that trend to continue as we fall into those fall months where we're gonna have cheaper corn over the next 2 years. I mean, the futures out there on corn is we're looking at $3 to $3.50 a bushel, and so I mean they're going to take lighter weight calves and they're going to continue to put gain on them. We see the same thing there for the heifer slaughter weights. Obviously a much lower weight, but we see the same trend there is to take those animals to higher weights. That's one of the ways that they've been able to take our beef production to the next level here in the U.S. And then just the overall picture there in terms of beef production. This is the real chart. You see, we're not that much different than 2015, but we're still below that 5-year average. We're above 2015, but we're below the 5-year average. In 2017, 2018, we're going to exceed the 5-year average. We're going to produce more beef than the U.S. cattle industry ever had with a smaller herd. The way we're doing it is with those slaughter dressed weights that we just looked at. And then with an increasing calf crop, that's all going to add to this beef production. So the thing that we really have to grasp moving forward as Florida cow-calf producers or just Florida stocker producers as well is that there's not going to be much upside on the price. The upside is going to have to come from utilizing more forages and working on our cost of production. That's the only the bright side there on improving margins is really going to be focused on hunker down on those costs. That's where I see any margin improvement there. We talk about imports and exports. We're in a much better situation in 2016 than we were in 2015. We've definitely reduced those exports, those imports coming in from Australia and New Zealand. But for the most part, we're still at 3.5% above our 2010 to 2014 average. And we talk about what's going to happen with Brazil sending their beef to us. I don't think much is going to change. We're not going to see a larger increase in terms of imports. What's going to happen is we're going to trade off the Australian beef for some Brazilian beef. They're going to ship it to us at the same price. We're just going to make a quick trade-off there. On the exports, people have been saying that these exports are improving for the most part. There's not that much improvement there. During that the kickoff of that grilling season where we have around Memorial Day there was some very good improvement back to those 5-year trend numbers. But for the most part, until global incomes start rising, there's really no more demand that's going to occur for our beef products. Incomes have to rise, and they're not rising. We've been talking about for the last 15 years is there's this new generation in India and China. They're growing incomes, and their middle class is expanding. Well, they still haven't made it to the beef industry. They're still looking at these cheaper meats and cheaper substitutes. So as we move forward, I look for nothing to really improve on our exports until global incomes for the wealthy and the middle class start rising here for beef. Just want to throw this chart in here. These are returns to cattle feeders. We talked about how much they lost in that 2015 range, during the second half of 2015, how bad those margins were, but they're still bad now. And the reason for that is we saw that first chart where we looked at those cattle prices. We looked at them for what they've done in 2016. As long as those prices are declining, they're in trouble because they bought them 6 months ahead of the time that they marketed them. So unless they use some risk management, these are, if they stayed in the cash market, which about 60% of the feedlots are staying in the cash market. They're buying this corn cheap, and they're hoping for a price improvement. You think after the last 10 years of data here that they would not have stayed in the cash market. They still are staying in the cash market. Only about 40% of these cattle are hedged on the futures market. So this was one of our questions, and we look at where cost of production is for cow-calf producers in the United States. These are our variable costs plus pasture rent and just a little bit of some fixed costs. And so for the majority of the United States, we're up there close to $900 a head. And it's too high. When we start talking about calf prices being under $700 a head, where we've moved as an industry is focusing on yield so much that we've really floored this cost of production over the last 25 years there. So can we produce calves a lot cheaper than other parts of the U.S. Yes, we receive lower prices at the same time. We're further away from the feed yards, but cost of production is really where we have to make our improvements as we move forward over the next 4 years with low cattle prices. This is the same focus of the chart, is that, you know, what have returns been historically? These are returns over those same variable costs plus they only include about $89 in fixed costs. So to cover all of our machinery equipment and then some of the fixed costs for operation, they're only including under $100 a head there. And what the takeaway really is here is that, you know, as inventory declines, profits increase. Inventory declines, profit increase, and then we see the same trend here in that 2013 to 2014 time period. Now, you know, on the flip side of the chart, we start seeing, you know, inventories increasing. In that 1994, 1995 time period, we started seeing some losses here. You know, in the magnitude of the increase, that's what was really going to capture the losses. You know, we had just I think it was a 3 million head increase there in that stunted cattle cycle that we saw in 2007, just minor losses. So the magnitude that we see on this herd expansion is really going to determine where we go in terms of margins. We're not starting off in the best place here at about $100 a head margin here currently in 2016. Moving into 2017 is just going to get tighter for us there. So there's 4 phases of the cattle cycle that we looked at. And I always put a little disclaimer there. So I understand, I know the direction of the market 80% of the time. However, we never know the magnitude. You know, we can determine the long-term projection of the market. We can determine the direction. We can't determine magnitude. James, you got that? Can't determine magnitude. So I did 10-year price projections in 2015, and where we are today would have been the 6th year of my projection, and we're on year 3. So not very good at determining the magnitude of this price cycle because there's so many factors that go into the price of beef. So this is typically what we see based on the last 50 years of studying these price cycles. We had the top of our price cycle. It's easy to say after it's already happened. Significant profits in that 2013, 2015 time period. We're in this downward price transition. And so there's these 2 phases are very good for cow-calf producers. This is terrible for feedlot and stocker producers. That's the phase that, you know, no one likes to buy cattle in. They like to raise cattle in these 2 phases. No, the feedlots don't like to buy cattle in a downward price transition. For cow-calf producers, typically, depending on your cost structure, it's profits and losses and declining profitability. The bottom, right now we're thinking 2018 to 2020, you really got to focus on your costs. There's going to be losses that are going to occur in the cattle market if we look at all of our costs, those economic costs as well. So we've got to get focused in lowering our costs if we don't want to have significant losses. Every year that we have herd expansion, we're going to lose another $50 to $75 a head at the market. So as we move into 2017, those fall prices for next year, we're losing another $50 to $75 a head. That's on 550 weight calves. You know, as we play with different weights, that magnitude there changes. No one likes to talk about it, but you know, 6, 7 years out there, that's where we're going to see the upward prices for the most part. Upward price movement in terms of a long-term projection there, 2001 through 2014. In the short term, this is what we're going to focus on, is that we got to go back to our seasonal price trends that we've seen over the last, you know, 75 years here in terms of winter calves available, and the reasons that there's reasons specifically here that we see these seasonal price trends. So really, the one I'm actually interested in is 1999 through 2009, because if we have to really throw out that last 6.5 years of data, because the magnitudes are so strong and it's an outlier event. We don't expect that to occur again. We expect for seasonal movements to get back into the market. So what we expect to see here is, if we look at 550-pound seasonal price index, a move up from January to March and April typically for these 550 weight steers. The reason we see that, there's not many 550 weight steers available in that March-April time period. Not many people are summer calving or calving during the summer. They're staying away from these October calves as they go through the stockyards. There's more respiratory issues, especially in drier conditions. They're staying away from those October calves. So that's why there's that substantial decrease of about 4%. So these are in terms of percentages, these indexes. And what you'll see is that typically in that March-April range, our prices are 3-year higher than average, and then during that October range, they're 5% lower than average. So I do expect to see this about 3% increase in price between November and December. Put a little asterisk there. It's going to depend on how the market reacts to the election. But that's what we expect to go back to for the rest of this cattle price cycle. The next 8 to 10 years, we expect it to move in a seasonal trend. So then moving forward to talking about a little bit more about cost. I want to get these answers question. So I like to, when I think about cost, we've got to work through our cow-calf budget to help us with just planning and controlling those costs in the long term and projecting profitability. So one of the things that we have available is our beef cow-calf budget at the Ranch Cattle REC. This is just a financial assessment of our costs. Allows us to calculate our costs and returns for our beef cattle operation, both actual costs or projecting them out for the next year. So it's on our Range Cattle REC economics page. It's our 2015 UF-IFAS beef cow-calf budget. And I'm just going to talk through you a little bit about some of those forage costs and those other costs that we see as we move through our cow-calf operation. You start out looking at reproduction. So the first question there was, where's we get to that one? What's the most economically important variable to cow-calf for cow-calf operations? And we talked about, was it reproduction, weaning weight, cost of production, or stocking rate? And the reason I put this question in here is because, all the media, all the journalists out there, they continue to say that reproduction is the most economically important variable, and it's not. They're only looking at their select variables. Now, if I don't include all the variables, reproduction, obviously, it's one of the higher variables in terms of profitability. It's very important to have successful reproduction. However, stocking rate, determining our stocking rate is the most economically important variable, and it's because look at where our industry has came from. I was talking to Wes Williamson the other day, and he said the exact same thing I was thinking. Is we went from 10 head per acre, 7 head per acre, and now we're stocked at 3 and 4 head per acre. So we were able to double our stocking rate, have twice as many animals. When have we ever doubled our reproduction? We haven't. So that's why stocking rate is so important to us. If we continue to make improvements in the stocking rate, we can increase that forage production that me and James are working on right now. That's why the stocking rate is so economically important to our cow-calf operations. So we start by putting in some reproduction data for our cow-calf budget. We're looking at raised replacement heifers in this budget. That's our next question. The first part was, and I'll be honest, as soon as he read the question, I could have wrote it a little bit better. It said, what costs should not be included when we're calculating our cost of raised replacement heifers? And it's interest expense. Now, there's two types of interest expense. Is interest expense on like your operating expenses. You do count that one. But the interest expense you don't count on raised replacement heifers is the interest of your capital. So whenever you purchase replacement heifers, typically from an economic standpoint, I charge interest on that investment. However, when you produce an asset, you don't charge interest on that asset because you produced it yourself versus purchasing it. So there's a difference there. And whenever we're looking at whether we're raising or purchasing replacement heifers, on the purchase side, we want to make sure we're getting paid a return for making that investment in terms of the money that we've made to purchase that animal. But if we're producing it ourselves, typically from an economic standpoint, we won't charge interest expense. Now moving to the grazing information, and this, this is really my focus on my entire program, is where can we really reduce costs of production, and I think it's through grazing. So for our grazing information, for the most part, what we're looking at, so I can't fit everything on the slide. So there's in the Excel spreadsheet, there's a lot of stuff down there, and it's got a lot to do with weed control, fertilizer costs, some additional machinery equipment, some mowing, all these additional expenses that we have in grazing information. But our focus up here is, what is the opportunity cost? What could we rent the land for ourselves? We want to make sure that we're paying ourselves for the use of our assets, and that's what I utilize there in the first part of this grazing information. Is to get the most use out of our assets. We want to make sure we're paying ourselves land rent. I figure that into what our cost of production is. That's one of the reasons those costs of productions are so high whenever economists quote them. Then we look at purchase and raise feed information. We're really looking at, what's it going to take us to meet those nutritional needs for our fall and winter calving system. I'm looking at what's it going to take us to meet those requirements when they're in that late lactation, or they're in postpartum or early lactation there. That's what we've got to focus on as meeting those feed requirements in the cost of carrying this cow. We've got all that animal health information, and I work with a lot of our animal health specialists here at the University of Florida, as well as in the industry, and making sure we understand how much it's going to cost us for the brood cows as well as the feeder calves for these health expenses throughout the year. I want to make sure we get all those covered. So we include an animal ID tag for the cows, and fly tags, and all the other things, the shots that we'll give that cow throughout the year. In terms of ownership costs, the equipment barn, a hay barn, if you got a shop, these are typical ownership costs. As we move down the spreadsheet, we're getting more into those fixed costs, our tractors, our machinery equipment. Now, everyone says, Section 179 depreciate the asset, so it's not really on my cost of production. Well, there's a reason for depreciation, and the reason I think about depreciation so often is, now I'm glad that expense is out of the way, but the reason for depreciation is because, if that asset lasts 10 years, in 10 more years I got to repurchase that asset, that mower, or that squeeze chute that may, depending on the useful life of it, if we bought a used one. That's why depreciation is so key, is because I don't want to have to reach back out there into my personal wallet. I want the business to pay for it. So that's why I think about depreciation in our fixed assets so often there. Operating costs of machinery equipment. If you're interested in what it costs you to operate a piece of machinery equipment, we can calculate that. Just looked at me funny. Operating the cost of this machinery equipment. Typically what we see on tractors is a 2% repairs and maintenance cost every single year. Now, is anybody selling machinery equipment in this room? Just want to make sure before I say the next thing. On the cost of machinery equipment. Now, I only own one tractor. I have 2 farms, so I own 1 tractor. And there's a reason for that. And the reason is because in the early 1990s, John Deere put out a manual to help people understand the cost of their machinery equipment. They quickly did not do that again. Because what we find is that you think about the the fixed cost, the cost that you pay for that machinery and equipment. And then, over each year you see, a small portion of those costs. Well, let me tell you this, the small portion of those costs will double the fixed costs that you paid for that tractor in 15 years. If you use it, we figure about 700 to 1,000 hours a year on a tractor for 15 years, you will double what you paid for that tractor in those variable costs. And the kicker is it's fuel. It's just doing the regular maintenance of the oil change. When I get my, I go and get all the filters I got to change on my tractor and the diesel that I got to put in the tractor. Man, whenever I don't have a big diesel tank, but whenever I go fill up for diesel, it's $750. And that only lasts me about a month. So those machine equipment costs on the tractors, it's killing us. Using that tractor as efficiently as possible, that's my focus on our place, is that that's why we only have one tractor, and it's got to do a little bit of everything. So understanding those variable costs, so much more important to understanding the fixed costs of that purchase. I will point this out. That's on stuff that that has a motor. The implements, it's not the same. On an implement, the variable costs typically aren't going to be as high as the fixed costs on an implement. But on those things that have a motor, that's where we really get in trouble, and it tricks us there. It's kind of like owning a boat, James. I'm not owning a boat. And then we have those other expenses. I always, if you have additional labor that you hire, typically when I develop a budget for someone, I leave the returns to the budget as their returns to their management. So there's some part-time, some hired day labor, some hired labor that you throw in there. Everything, whenever you're looking at the budget, if you work through one, it's not easy, but it'll make you really think about working through your operation and what you need and what you don't need there. Then the marketing information. When I talk about marketing, this is another question, James. When I talk about marketing, one of the things that I really like to focus on is that your cull animals, your cows and your bulls, are 15 to 20% of your revenue. So whenever we get the calves gone, our marketing work isn't done. We looked at that seasonal price trend of the calves. Our slaughter animals are going to be the same. So selling those slaughter animals at a time when the prices are higher, and for the slaughter animals, we're going to see it in that March through May time period. Right now we're typically at our seasonal low in terms of our cull animals. Okay, which one? What is that? Okay, so there's two questions there. The first one that I'll get at, we get back to the replacement heifers, and it's again that trade-off between raised and purchased replacement heifers. It was raising your own replacement heifers typically increases your cost of production. I look at it, it's false, and I would say it's false for 95% of people, and this is why. It reduces your cost of production because you don't have the depreciation and the interest on purchasing an animal. However, it reduces your cost of production. It also reduces your revenue. So you got to make sure it doesn't reduce your revenue by more than your cost of production. So whenever I look at purchasing versus raising replacement heifers, I want to make sure that the animals I'm raising are of adequate or better quality genetics than the ones I could buy. But overall, raising is typically cheaper than buying because of that trade-off. You said 5 minutes?
I gotta get for that.
Okay.
All right, so let's say last year you raised your own replacement heifers. Well, let's say in December of 2015 you raised your own replacement heifers.
Okay, your answer is the exact opposite of what I just said.
Okay.
So if I had raised replacement heifers in 2015, I held those heifers, didn't sell them at $220 per hundredweight in July of 2015. I would be able to buy those heifers on the market $13.50, $14.50 a head come this spring.
But that's not typical.
That's not typical. I would say that there was 5 years in the last 50 years, because I looked at that data. It's actually, I got a sheet over there that's on. But in the last 50 years that occurred, there's 5 years where we saw that dramatic decrease in terms of bred cow prices. So that's an outlier event. So then it started putting in some results. These are for 2015. I worked through the numbers with a ranch that was in Central Florida. They had some exceptional calf prices that they received. They marketed in May for some early fall calves that they had in 2014. And then again on that cull animal revenue, so very important to us on that side. You can see there it's 25% of our total cow-calf revenue there. And then looking at our fixed costs, again, depreciation, interest, some of those repairs and maintenance. Some repairs are fixed costs, some are variable costs. It depends exactly on what it is. Taxes and insurance, we won't have those same here for the most part, but this operation had a little bit of land in Georgia as well, I believe. And then higher labor and management, we didn't include that there. So that therefore our returns are going to be to our management as well. Variable costs, we've got our pasture costs up there. And this is where we typically see pasture costs on a cow-calf unit. I just quoted one of our large ranches in Florida, $127 a head, and that's about where they are. Our feed costs, they were up here at about $172 a head, so they're very intensive. I think their weaning percentages were in the high 80s. That's why you see those high feed costs for the brood cows. Making sure we put all these animal health costs in there. Whenever we add all our animal health costs up for our replacement heifers, our bulls, our calves, we're looking at close to $35, $40 a head, because all those shots that veterinarians recommend us for those feeder calves adds up. You've got that machinery equipment stuff in there as well. And then we have those estimated returns. We're looking at $200 a head. And so $200 a head here over, I have a very strict structure. That's what we were looking at there for their cattle company in 2015. So we'll answer that one last question. And this was a little tricky question too. It said for most producers the cost of owning a bull was over $600 a head. I believe that to be true, and this is why. Because of depreciation and interest. Now, $600 a head, if that was our annual cost for owning a bull, for a 30-head cow-calf unit running 30 cows per bull, that's $20 a head in terms of being able to breed those cows. I think that's very realistic. If you looked at where bull prices were over the last 3 years, we were, for the most producers, we're closer to 1,000 because of where depreciation was. We're only keeping that bull 4 to 5 years. Those costs were way up there. When I charge interest, now I'm charging it much higher than what the banks are charging on interest for the most part. I was using farm credit to calculate, what they would give us on a cattle operation loan at 4.5% at $4,000 bull. We're over $160 a head there just in depreciation.